Hey everyone, thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TraderBait, which has a custom web app dedicated to trading. CME groups do daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderBait's main platform as well. They're a great way to get exposure to the futures markets with limited risk. Go to placeyourtrades.com and get the TraderBait app for free. I also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. It's absolutely free. I will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. So if you're interested in getting this PDF, just click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. It'll be available and emailed out to anybody who signs up. Just as a reminder, this material is presented solely for informational and entertainment purposes and not to be construed as a recommendation, solicitation, or offer to buy or sell long or short any securities, commodities, or related financial instruments. Please contact a licensed professional before making any investment or trading decisions. And with that, I will introduce our guests. We have BenRabidoux. I hope I pronounced that right. Is the founder of North Code Advisors, a boutique research company covering Canadian housing, macroeconomic, and household credit trends. North Code Advisors is consistently ranked in the top 5 for Canadian economic research by Brendan Wood International, as voted upon by institutional investors. He's a frequent commentator on all matters related to housing and household credit, having been featured in nearly every major Canadian media publication, as well as a number of business publications internationally. Next, we have Melody Wright. Melody is a 24 BFSI veteran. Melody was recently named as one of Mortgage Women's Magazine's Women of Technology, and is contributing writer to multiple publications. Her January article in HousingWire entitled "Debunking the Housing Inventory Myth" is currently creating controversy and sparking debate in the industry amongst the investor community. Melody began her mortgage career at GMAC in 2006 and helped manage the historic ResCap bankruptcy. After leaving ResCap and before joining the fintech revolution, she focused on operational effectiveness at multiple large non-bank mortgage companies. Melody's launched her own strategy and technology company just last spring, Haringa, which assists which assists the investor and industry community with navigating the ever-changing macroeconomic landscape, utilizing market data and comprehensive integrated technology solutions. With that, thank you both for joining us today. And how we do this is in a round. So we'll have basically 2 rounds and then a final round, which is a final thoughts round. So I wanted to start with Melody. So let's start with the U.S. housing market. It seems, at least on the surface, the housing market still remains pretty tight. Our mortgage rates are coming down. Delinquency rates still remain fairly low by historical standards, and it seems everything is okay. But can you walk us through a bit of what's really going on under the hood here?
Sure. And Tracy, thank you for having me today. So yeah, it's a confusing time and we're seeing a lot of conflicting narratives in the media, but I would just encourage everyone to educate, look under the hood because they're just narratives. Mortgage rates are coming down and I think that for the housing bulls, they think that the buyers are going to come back in force. But I think that what most in mainstream media don't understand is that this is more about home prices and folks cannot afford. We're at record levels of unaffordability. So I personally believe that there will be some limited demand coming to the market. However, the sellers are going to take this as their cue. They've been waiting. They've understood that the housing market is frozen. And so I think that what these lower rates are actually going to do is bring sellers to the market. At the same time, that you're kind of seeing multiple things come to play, which essentially are, we've had a ton of speculation in this market. I think that's another thing that housing rules just they underestimate. And primarily because I think a lot of the investors have used government programs as well illegally. And so with that speculation and sort of that Airbnb bonanza that's happened, and oversaturation of Airbnb markets, we're seeing people coming under significant stress due to increased property tax insurance. And we have a ton of these. Many people try to dismiss this because they've really not done any homework and they look at Airbnb when you search city, it'll say 1,000 properties plus in the top left corner. But what they won't tell you is that there's over 14,000 Airbnbs listed in Austin, for instance. So that's a big leap. I think also a lot of folks that got in for long term rental are starting to get out as their cash flow is getting impacted by the enormous increases in property tax insurance. And I think the boomers are starting to list their second, third homes for sale because they realize if they were in that long term rental market, it's much easier to just have your cash sit and make yield versus having to traverse what is becoming a really complicated rental space with, you know, tenant over the top tenant friendly sort of laws, et cetera. So I think a lot of these are happening at once, but the housing market is certainly not what I would say turning around. We've got a long path ahead of us that and I'll say something a lot of people think is shocking, but if they did a little bit of homework, they would agree we overbuilt from both a single family residence built for rent and multifamily, and we don't have the demographics to support it. So there's a lot of confusing noise out there, but I would say that path ahead is not a positive one for the housing market, or positive if you're trying to buy an affordable house. I would say, but that could be a long time coming, depending on whether we have a credit event or a recession. But even if we don't have either, I believe, you're going to that weakness. To speak to your point, Tracy, about delinquency, the media is very focused on those 90 plus delinquencies. But the matter of fact is that we should have 80, 90 plus delinquencies. We throw more money at this, more programs to keep people in their homes during COVID, including 18 months of deferral of payments, which is unprecedented. So the fact that have any strikes, and then on top of that, if you look at our 30 and 60-day delinquency, those early delinquency, it's very shocking how high those are, especially in that government FHA product, which is your more vulnerable borrowers. And so I've seen delinquency tick up, and I think we'll have more material delinquency by June. But in case anybody's wondering, we're tracking with about for 2006 in terms of where we are delinquent.
And then you brought up new construction, right? And so let's talk about new home builders for a minute here. They've done amazingly well in the stock market. So, and I think a lot of that, if correct me if I'm wrong, is because they've, been subsidizing mortgage rates, so to speak, to
Correct.
entice buyers. So, you know, are are they making any money? And as traders, as
Yeah.
investors here, we're like, me, is it time to get out of this market? Is it time to
Right.
short this market?
Right. Yeah. So their margins are definitely getting compressed. And it trade, yeah, a lot of people. So when you listen to the builders talk on the earnings call, it's a lot of, hand wringing over the 2008 crisis, and we learned our lesson. And I have had many people tell me I'm crazy when I say the builder's in trouble. But all you need to do is go to one new build site and see what they think that they're going to get for these homes. Look at the median income and look at the demographics and know that there is serious pain ahead. Now, before anyone gets too excited, I personally believe that we are, of course, rounding the corner to an election year, and the government is going to get involved. Affordable housing is going to be on the top five topics, I think, for this election. And so I very much expect that the government will get in and subsidize some of these builder write downs on the condition that they pivot to affordable housing. But, so whenever anybody talks about shorting the builders, things like that, I just ask them to keep in mind that the government has a lot of vested interest here, and they bailed them out before, particularly Lennar.
And then one more question I kind of wanted to go over. Back in November, I thought was interesting. You said something broke at Fannie and Freddie. So can you, well, first, maybe for people that don't know what Freddie and Fannie are, maybe briefly say what they are, and then uh, elaborate on what happened.
Okay, I'm trying to recall exactly what that was. Um, but Fannie and Freddie are the GSEs, or the government sponsored enterprises. And in reality, I think where a lot of people forget is that, private money really left the regulated mortgage space after 2008 and have a very small 5% of the market is non-government and kind of private. And then the rest of it is really your government sponsored enterprises, as well as Ginnie Mae, that includes FHA, VA. So what broke in November? There's been a lot going on in terms of, uh, what I see happening with them recently that it's really concerning to me is that they're truly trying to push, it's like the last gas, and they're trying to push what I would call risk lending. For instance, in November, they announced a multi-family program with very minimal amount down, hopefully, in their words, trying to help, lower income immigrants, minority families be able to get into investing. And when this stuff happened, that, this kind of a sign of late cycle. And in reality, they're pushing people into products they can't afford. So Tracy, I don't know, you may need to remind me specifically.
No, I mean, that's fine. I mean, I'm sure there's a lot of problems. So if you could just, I think you went into the inherent problem. So I
Yeah.
think that's good.
Yeah.
All right. And then we'll come back to you, of course. Let's head over to the Canadian housing industry. And if you could mute yourself, what? You're not. Yeah, thank you. We're just getting an echo for some reason. It happens. So let's go over to Ben and dig into the Canadian housing market a little bit here. I don't know. It seems that the housing bubble in Canada just keeps growing despite calls of impending doom, um, particularly with higher mortgage rates. So, really, what's going on in this market, and what are some of the issues that are unique to Canada that we aren't seeing in the US?
Sure. Great question, Tracy. And thanks for having me. I think to frame the issue, it's really fundamentally an affordability issue off the bat, right? So we're seeing right now in Canada, affordability is the most stretched it's been since the early 1990s. A simple way to think about it is to just look at the mortgage payment that a buyer would need to kind of buy into the market at prevailing prices and prevailing rates. And it's effectively doubled over the last year and a half. So it's just an enormous headwind to demand. What we're seeing on the ground, if we kind of go back in time to 2022 when the rate hike started, we saw a significant drop off in demand. Some of the major metros in Southern Ontario saw sales fall effectively to 1990s levels. So it's a steep drop in demand. But concurrent with that was a decline in new supply. So by the time we got to the back half of 2022, we were seeing 20 to 30-year lows in new listings coming online right through the back half of the year. And so what that set up for was when we came into early 23, we had a bit of a pullback in mortgage rates into kind of the low 4% range. We saw a bit of an uptick in demand, but it came into a very supply constrained market. And so what that meant for prices is we had a pullback off peak of about, call it 15% nationally, varies significantly by kind of the geography, but anywhere from 5 to 25% peak trough. And then this spring through the summer, it effectively recouped half of that. So we had kind of a 7-8% rip straight through the summer as you had this uptick in demand into a very supply constrained market. Now it's rolled over since then, and we've now seen 3 months of declining prices and pretty substantial declines. And so we're back to being kind of down 15% from peak, give or take. And that's already a fairly historic housing downturn in Canadian context. You really have to go back to the 1970s to find a time when the prices have come off peak trough that much. Now, in terms of like so that's kind of the lay of the land. Now, what's interesting the last few months is we're starting to see a normalization in new listings into a very demand constrained market, which is different than what we've seen in any other prior, what you might call like a mini downturn in Canada. So we've had a series of very short, shallow housing downturns going back. Even the financial crisis in Canada was kind of a non-issue here, kind of a 6 to 12-month affair. And then we recouped to record highs. And we've seen that since then we had little downturns in 2013, 2015, 2017, 2020. And every one of those was characterized by a steep drop in sales, but a concurrent drop in listings. Now, what's different today, and the one thing that I think people need to keep an eye on, is we are now seeing very weak demand, but a more steady increase in new listings coming to market. And that's something we really have not seen. And so to kind of contextualize that, if we look at the inventory build, so now we're talking about like active listings currently on the market, we've seen a 50% increase over the last 5 months in Ontario, and that's after adjusting for normal seasonality. So we're seeing a very steep increase in listings coming online at a time when demand is weak. And so that's really what's causing the second leg lower in prices, as it were. Now you asked what's unique to Canada. There's a lot that we could talk about there. I think if you compare it to the United States, the one thing that concerns me, I mean, there's a bunch of things concerns, but one of the big ones is if you pull up a chart of the debt service ratio for households and you compare where the US is and where Canada is, like historically, they kind of tracked each other more or less. And then they diverged sharply during the financial crisis. And in the US, you had a lot of loans either written off or sort of just a natural deleveraging. And today we're at a point where the debt service ratio is about to make record highs in Canada and is kind of bumping along near record lows in the US, in part because of that deleveraging, but also because US consumers are able to term out that debt and lock them in for 30 years. We don't have that luxury in Canada. By and large, the longest term that you can get in Canada is a 5-year. And so we're sort of exposed to rising rates at renewal. And so one of the concerns is you can make the argument that the US consumer, despite any potential vulnerabilities, is going to fare considerably better this cycle than the Canadian consumer. And it raises some concern that like, until the US consumer really breaks and we start seeing the Federal Reserve pull back, it's going to be really difficult for the Bank of Canada to move materially to kind of soften the blow without causing sort of secondary problems with the currency and with imported inflation that way. So that's one thing that concerns me. We are absolutely seeing a lot of vulnerability. I think kind of the household debt situation in Canada is well understood, but it's now come to a head, and we're seeing significant exposure, significant vulnerabilities due to these rising rates. The second thing, and something that we can touch on, is just what I perceive as an underappreciated risk in the new construction market. We've got a record number of dwellings under construction heavily skewed towards condos. So we have about 180,000 condo units currently under construction. The concern is the way that the construction process works in Canada is typically developers will pre-sell 70, 80% of the units, and then they'll get their financing to build. Now, one of the things we've seen over the last few years is this kind of progressive increase in the premium that people were paying to buy pre-construction. Okay. So in other words, you go back a couple of years ago, we had instances where people were paying 25 to 30% premium to buy a unit that's going to be delivered 4 or 5 years down the road. Okay, so they're paying significantly more than they would in the resale market. Now, some of that was that's entirely a speculative issue. People were expecting prices to increase. The issue today is as those units are going to complete, unless we get a material increase in house prices, um, when it comes time to close on those units, those buyers are going to find that the units don't appraise, and they'll have effectively a capital call at closing, and it's going to result, I believe, in significant stress, more an issue in kind of 25, 26, as these units complete at substantial premiums to kind of the prevailing market price. So that's kind of where we're at, and a couple of things I'm worried about, and I'll turn it back over to you, Tracy.
So what are delinquency rates looking like in Canada?
Yeah, great question. They're still basically at rock bottom. If you look at the official delinquency rates, it's like 15 basis points nationally. It's really not happening. Now, a part of that is just due to the buildup in household savings coming out of the pandemic, right? Which I know is also a U.S. phenomenon. But also the fact that the labor market's been just remarkably strong, and also in Canada, like we have a lot of policies geared towards sort of giving borrowers time to self-cure. And so banks will do a lot in terms of extending amortization, giving payment relief, doing everything they can to kind of buy borrowers time. And so we're not seeing it yet. If you look at some of the other sort of secondary indicators of credit stress, so whether it's credit card utilization or delinquencies in unsecured debt and autos, all of those are starting to trend significantly higher. But again, coming off a really low base. So we're really only now getting back to kind of pre-COVID levels for most of those, with the exception of auto loans, which are up to kind of like a decade high. Those numbers are absolutely going to trend higher. We're going to see them, I suspect, double or potentially even triple over the next year or two in Canada, which still is not an alarming number. If you think of like delinquencies in the 50 basis point range, doesn't sound alarming, but we really haven't seen that in Canada since, I don't know, probably the 90s.
And do you guys have the same, we've had our government really throw a lot of money at this, as far as government programs and things like that. And I know you guys had a new Canadian mortgage charter. I don't know if that means anything at all, and if you want to explain what that is. But is the Canadian government as involved, say, as the U.S. government is in the housing industry?
Yeah, arguably more so. So the housing charter, I would say, is really, I mean, I wouldn't spend too much time on that. Most of that is recycled. It's policies that were already in place, and all that they've done is sort of, it's a bit of political theater. There's not really much there that moves the needle. Okay, so all of those policies were already happening. I wouldn't spend too much time on that. In terms of the government's involvement, we have a very large crown corporation that provides mortgage insurance on high ratio loans. And so in Canada, if you have less than a 20% down payment, the loan has to be insured. And so it does protect some considerable exposure for the lenders. The major player in that space is a crown corporation. Then you have two quote unquote private insurers, which have a de facto backing from the government in the event of insolvency. So yeah, they're a major player. So if you have very low down payment in Canada, the government, you pay a premium, but the government will effectively insure that, and it gets the buyer much lower rates than they otherwise would.
And is there still a big influx of like offshore money, so to speak, particularly in the Vancouver market, or has that dissipated? I mean, are people finding it difficult to find housing?
Yeah. So
Or,
sorry, Tracy.
you know what I mean?
Yeah, I do. So the influence of foreign buyers, I think, peaked in 2017. So we still have significant capital inflows. It gets tricky. You have to remember in Canada, very robust immigration. Okay. And so, and overall population growth was 3% in the last year. So contrast that with the official numbers in the US of kind of 0.5%, not including illegal immigration. So where those lines get a bit blurry is like the distinction between a foreign buyer and foreign capital that is backing a new Canadian buyer, if that makes sense, right? So it's very easy to send a family member to get citizenship in Canada, and then they become sort of conduit through which capital flows into the country. And that's where those lines get a bit blurry. All of that said, my thinking on that is that influence peaked in 2017. The government's now taken a much harder stance against foreign speculation in Canada. So, for example, they've implemented a number of foreign buyer taxes in Canada. So it's very difficult to buy if you're a non-resident without paying a tax. But I think more importantly, what they're trying to do is move towards a beneficial ownership registry at the national level. And so, Canada was a very welcoming jurisdiction. If you wanted to remain outside the purview of, let's say, Beijing, and you wanted to park capital abroad, Canada was a very welcoming jurisdiction. You could set up a numbered company. You'd have no sort of no way to trace back the beneficial ownership to yourself. And the federal government is now looking to change that. And so I think that's sending a strong message that Canada's just not as welcoming a jurisdiction as it once was. And in addition to that, if we look at what's happening in British Columbia, which is arguably kind of the epicenter of a lot of that kind of foreign capital, they've taken a very sort of confrontational approach to international buyers, including bringing in what's called an unexplained wealth order. Okay. And so we have the situation in Canada where you have a number of, $20 million homes in Vancouver where, it's funny, you can actually pull land registry titles in Canada. And in Vancouver in specific, it actually lists the occupation of the owners. And so, you pull these documents and it's all like housewife, like nobody worked. Right. And so these multi-million-dollar homes are inhabited by individuals claiming poverty level of income that is insufficient to even pay the property taxes. And so clearly there's some sort of, illicit activity or something happening there. And so what the government has said is, look, we're sick of that. And we're going to bring this unexplained wealth order. And effectively what it allows the government to do is say, basically explain yourself. How can you claim poverty level income and be living in a $20 million home? Explain yourself. And if they cannot, it effectively forces them to appear before the courts and give an explanation for why their income is so incongruent. And if they can't explain it, then there's a provision there whereby the government can initiate a recovery proceeding. And that's very new. In fact, the very first incident, I guess the first case is about to be argued before the courts, like right now. But it just gives you a sense that like, this is a very different environment than it was a few years ago, where the governments at all levels are recognizing the magnitude of the problem and trying to do things to kind of curb it.
How do you even get a mortgage with the bank saying that you have no income?
Oh, Tracy, this is Canada. It's all sorts of ways. I mean, look, for the folks on the call, I mean, I would say you'll want to pull up, go to YouTube and Google CBC mortgage document fraud. So CBC, which is our national news entity in Canada, did some pretty great work undercover on just the magnitude of mortgage document fraud in Canada. I'll just say it's a much bigger issue than people realize. So that's one thing. But secondarily, we have a very robust sort of private lending market, which is often peer-to-peer, unregulated. And so there's always ways to get a mortgage, right? And in many cases, with the houses that we're talking about in Vancouver, like many times they're not mortgaged, it was foreign capital. But the point is that they, they're basically claiming like $15,000 of income against a home where the property taxes are more than that. And it's just like, none of that makes sense. And the government's clearly just getting sick of those sorts of shenanigans and kind of sick of Canadian properties being used as sort of a international safety deposit box. And that's changing significantly as we speak.
Excellent. Thank you. And we'll come back to you. We'll go to Melody. Now, are we seeing any kind of fraud in the US?
Oh, yes.
Speaking of
We're seeing
fraud?
yeah, we're seeing a ton of fraud. And I just kind of want to speak to one of those comments. I wish that we would get a beneficiary matrix here or table. Right now, the only way you can really get that information is to go to the county records, which there's over 3,000 counties, some of which are still in the Stone Age, pick up the technology with their fax machines or pencils. So it's very difficult to see ownership. But in terms, and another thing that Ben said is one thing I've been uncovering recently and doing a lot of research on is that when it sprung up, since, we push kind of that private renting out of uh, mainstream, we're seeing private note market spring up that's really outside the purview of the regulators, where it's kind of more of that peer to peer or just individuals doing lending. And I think that that's going to be a surprise to a lot of people. Just not a lot of people are talking about this. I'm just doing some discovery work on it, but what we're hearing is that essentially what happened during when we were on all of our enormous programs for deferment, forbearance, etc., if folks were delinquent, private individuals would, kind of figure that out, counting records, and then they would go to the individuals that were delinquent, say, "Hey, listen, I can give you some cash right now if you want to sell your home." They do a thing called contract for, and that individual who was not the homeowner would then start paying the mortgage until they found an investor who wanted to kind of buy the property outright. Outright. So this is just one example, but there's a ton of this private note lending that's going on out there that none of us really understand. That I wouldn't say all of that is fraud. I think they're probably very. I've talked to many very reputable actors in this space, but I would say because it's not being really out there that it's rife for border fraud and trouble. And I've definitely seen big bill county records of what I would call deed flipping, where sure you have a ton of different deeds on one property, but in the United States, we proceed on possession of that promissory note. And so I think a lot of people are in for a real surprise that just because they recorded it doesn't mean they're going to be able to prove ownership of real law. So that's one kind of risk area, and also where I think there's going to be some fraud. The second place is have a lot of non-owner occupants fraud. The FHA was supposed to be a program for first-time home buyers. Those loan limits now in some areas are around $1 billion. I mean, it's just insanity. These are really first-time home buyers. And what's happening, because you don't have to put a really low down payment, you don't have to put a big down payment down, is essentially they're using those FHA programs to do investment property. And so when they get those loans, they're supposed to sign an affidavit that says they're going to occupy the property for at least a year. And but they have no intention. And I see this in my client books as well. And I've heard, and I'm a big supporter of our veterans, but I've also heard that our VA programs are being this way, especially in places like Hawaii, where you have a military presence, but you also have a huge short-term rental market. So, and then there's just the regular everyday, because of the amount of speculation. And of course, Florida is always rife with this, Tracy, where you are in Miami. It essentially you're seeing all kinds of news stories, and it's just coming out of people, saying, "Hey, do you want to invest in a multi-million-dollar condos? Give me $100,000." And this, no project really existed. So that's kind of the run of the mill bug. But what we heard recently from the FBI is that complaints have increased exponentially since 2020.
Oh, that doesn't sound good. So are these people that are using FHA loans for, say, Airbnb or, whatever, that they're not the primary residents, are these actually first-time home buyers, or is that a fraud too?
Yeah. Well, so the program kind of worked. And I think what people don't understand is when we pushed all that private lending out from under the light, I would say, the FHA kind of came in and took up that into space. So we have more than doubled our FHA lending since 2009. And no longer is it a requirement that you're a first time home buyer. They have different requirements. And so that program has really gone off the rails for its intended purpose. And I think, you know, in the United States, because housing makes up anywhere from 12 to 20% of GDP, you have to keep the machine going. And ultimately, what's happened is the government has come into the place of the private market and has kept pushing the machine, after the crisis, bringing more and more folks trying to increase home ownership. That's something I've mentioned on other shows. Like look back over at the history of the United States. And at any time the government tries to push that home ownership level over that 65% mark, trouble has always ensued. But you had the government participating in the space, say they were really just trying to help first time home buyers. But of course, the consequences are that instead investors programs.
And then you tweeted out and said, if you haven't heard of it, be sure and note the term provision.
Yeah.
We're going to be hearing a lot more about that. Can you kind of go into that a little bit?
Sure. That's provision for loan loss. And so ultimately, I lived through the last crisis and I worked in corporate finance at a top five origination company. And I can tell you that in 2007 and 8, there were days you would walk in and say, we had to do $800 million more write downs. We've got to take more provision for loan loss. And that's typically on your loans that are held for investment. You're going to hold those on the balance sheet, have to take that provision because looking out ahead based on the credit quality of those borrowers and their payment history, that there is a lot of trouble ahead. And, default very, very expensive. Taking these properties through the default process takes companies down. It's been a long time since we've had to do that at scale, and it should become even more expensive. And so those provisions are going to get larger and larger.
And then what are your thoughts on, all these new companies that are new mortgage lending companies that are coming out with this 1% down? And,
Crazy.
what's the inherent danger of this? In the
Uh,
sound.
it's danger, danger, Will Robinson. Like, I mean, I looked at Rocket, UW companies, and these are all players that did not get smacked the way that the top five did the last time around. And that's something I think a lot of people miss, that the banks really got out of the gate at scale. They still will buy mortgage-backed security as collateral, but they don't hold servicing rights, and a lot of that has to do with Basel III and trying to risk off their balance sheet. And so these non-banks are in for a world of hurt for a lot of reasons because when you're in this space, you are at the kind of the center of many different entities with diverging interests, be it the GSEs, maybe Freddie, or the investors, or the consumer. None of those three folks have the same agenda. And so what happens at times of crisis is it all sounds really good. The GSEs or FHA are going to back those mortgages, theoretically reimbursing for your expenses if they do go to default, or in the case of FHA, you're supposed to make you completely whole. But this is the government, and these are insurance claims. And often what happens is you don't get paid timely or they deny your claim. And then the other thing that they do is they turn around to you and they have to purchase a loan because you forgot to dot an I or cross the T. And this is, and I'm exaggerating a little bit, but this is their way of ensuring that they make it through the crisis okay, and they will. And so that's already been happening, but it'll start to happen even more as more and more loans go to default. Because I can tell you absolutely, our repurchase back to the crisis, any loan that made its way to default, one of the agents say, you did something wrong in the origination process. Now, what happens is that because typically when you're servicing these loans, you aren't the one that originated them. And so then you have to turn to whoever originated and say, hey, you messed this up. But quite frankly, a lot of them don't have those balance sheets to be able to handle that. So it kind of creates a chain effect. But, the non-banks, whatever they may say, and again, this is where I would tell everyone to question areas. There's nothing rosy in their future. The only thing that's going to keep them afloat for the next little bit is going to be their late fees or ancillary income. And the fact that rates are going down right now are going to be a huge hit to the non-bank because that means they have to write down their MSR or mortgage servicing right asset. Because when rates go down, you can expect to some degree, not as much in this rate environment, that your prepaid speeds are going to be faster, meaning that people are going to try to refinance when those rates go down. So, there's just not a lot. There's not a rosy picture for the non-banks to have it. No good news.
And we're starting to see housing prices come down a little bit here. Is that one a cause for concern? Does that mean we're headed for, say, a price collapse? What does that mean for the economy? And do we see sellers suddenly rush to the door?
Yeah. So, for some people, it's probably a cause for concern. For an American citizen, I don't think so. But, of course, those Americans that are in those homes right now, it is a cause for concern. But for those that want to buy, so what I would say is that I absolutely think that prices are coming down. I think that if we have no credit event or we don't have kind of an exponential increase in job loss, that is still the case. It'll just take longer. And so without those two things, I kind of see home prices coming down around on an aggregate basis, 5% next year in 24, but then much more in 25. Because I think that the government's going to get involved, really try to slow all this down because no one wants to be talking about, default in an election year. And then we saw this already with the VA moratorium. So, essentially what would happen is there's some claim out there that VA veterans were told they'd have a certain solution by some bad actors or servicers that wasn't there. And so within days, essentially VA, there was a moratorium put on VA foreclosures, as opposed to just kind of trying to look into it to see what happened. And I think we're going to see a lot more of that. They're going to try to slow it down. But in my opinion, it's not going to stop it. And are essentially with lower rates, sellers that have kind of sitting on the sidelines are going to come to the market. And also, some are coming without because they're under a lot of distress. They have several investment properties. They're getting what's essentially a margin call, or they're not being able to refi, and they're not cash flowing. So I do think that home prices will come down, but if we don't have some sort of credit event or material job loss, it just could take longer than I think some realize.
And I would assume some places are more insulated than others, or do you think it's going to be a countrywide phenomenon?
Well, so I think both things are true. I think it's definitely there are some places that could see that double-digit increase. A lot of people talk about it like the Midwest, but I've seen Cleveland areas like that actually have some of the highest delinquency. And so I think even the places that weren't crazy are going to see an impact. But of course, there are going to be locations such as Florida that are going to be more adversely impacted, and I think also faster. We'll see it faster. Those areas where there was just rampant speculation, of which Florida is one.
Excellent. I'm sure everybody that that's listening, living in Florida, loves to hear that. Um, and then, and then one last question before I go back to Ben. I just thought it was interesting because you have a lot of you have a lot of tweets kind of on like the cyber attacks in the industry. So is this a fairly recent thing? And what problems is this causing?
Yeah. So there's one of the reasons I keep tweeting about it. People probably think I'm a crazy person, just typical, but it's that no one's talking about it. We've got significant borrowers in our country, our significant household that weren't able to make their payments, et cetera. So this is concerning on a lot of levels. One, that no one's talking about it in the mortgage industry. It's one of the most highly regulated industries in the country. So it kind of sits next to healthcare when it comes to privacy data in terms of, how much security you have to have because you have all of your information. I mean, everything, the cars you own, the houses, all of your financial information are at mortgage. So to be that regulated and for this to happen, that's the fact that no one's talking about it is very concerning. And the other thing is, these companies aren't being upfront with many of their borrowers. We still don't know how many people are impacted. Mr. Cooper, but they sure have now time to sit down with KW to say that they didn't think there was going to be a big deal about it. Well, I've been in this space for a long time. I can tell you the regulators are going to have a real big problem with it. The other thing is that Mr. Cooper likely was not able to make its full advance to Fannie and Freddie, Jenny, meaning that those entities would have to advance to the trust themselves and not be made whole. This is really a big deal in terms of liquidity in the capital market. So it's a very complicated topic. Hasn't happened before. We had some kind of breaches back in 21 of the title company, but this is, and then Lakeview was one, but in reality, it's the biggest data breaches we've really ever had in this space. I would say that it's unprecedented. And I just find that, the one thing that people don't often talk about is you don't get to choose your servicer. So for instance, let's say you pick the person to do your loan. They're going to turn around tomorrow. They're going to sell that home. They're going to sell the loan to the GSE and someone's going to retain that servicing right. They may retain it and then sell it later. But likely it's someone else that's going to retain that servicing right. And so therefore, you don't get to choose your servicer. And you can't just leave. You can't say, I don't want you to be my servicer anymore. The only way you can get out of a situation is pay off the loan. And so consumers are trapped. So, when Mr. Cooper says, hey, we don't know if your data was breached, blah, 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 but certainly you're getting all the spam calls. You can't just say, you're fired. You have no recourse except to write a complaint to the Consumer Finance Protection Bureau, the CF. So it's complicated and big, but many aspects of it are very troubling.
Well, that not really good news either. So we'll go back to Ben. And speaking of odd things happening, I don't know. I saw that there seems to be a rash of construction fires going on in Canada. What do you think is going on there?
Yeah, it's a little suspicious to say the least. So that's kind of related to that issue I mentioned earlier, which is just that a lot of these developments were pre-sold at these massive premiums. And see, the interesting thing is the fires that we've seen, and look, you see fires, there's always fires that happen, but you can't help but notice if you're watching here in Canada that we've had a number of them where even the police themselves or the fire folks have said, this is highly suspicious, right? Now they've all been in the low rise space. And the reason that that's important is because there's a much shorter construction timeline for low rise. And so what we're seeing today is low rise homes completing where they were pre-sold at a substantial premium. The resale market has softened and now they can't get financing. People are walking away from the deposits. And so that's the dynamic that's coming in the condo market more in kind of 25, 26, where these homes, people aren't going to get the financing for them, right? Or if they can get financing for them, they're going to have to come up with pretty major payments, right? The bank's maybe going to say, well, we'll loan you 80% of the fair market value, but you've agreed to pay a developer another 30% on top of that, right? Well, where's that money going to come from, right? And at that point, the deposit that you've paid is gone. It's vanished in the negative equity. Are you incentivized to close? I don't know. We'll see. This is not really something that we've seen happen in Canada before. And so that's kind of that whole dynamic of these developments mysteriously burning to the ground. I think all of that's related to the fact that we've got real stress coming in that development space.
I'm sorry, I forgot to unmute myself. And With the Canadian housing prices coming down and things like that. There was recently an article, I don't know if you read it or not, um, basically saying, is this a blip or is this a blown crisis? So, how do you see kind of the state of this market right now as a whole? And is it affecting provinces differently?
Well, look, I think the answer is if rates stay anywhere close to these levels, we've got a real problem here, right? So to date, we've only had about 30% of households have felt the impact of rising rates. And that's related to just the composition of the mortgage market itself, which we can talk about. But the point is, if you fast forward and you look at renewals coming in 24, 25, and 26, the payment shock that's coming is going to be substantial, right? And so, it'll peak in 2026 likely. But if rates are anywhere near these levels, like I'm telling you, there's going to be a pile of of distressed sellers coming, because we're facing payment shocks that are anywhere from 30 to 70% if rates stay where they are. And so that's really the key variable. This is not a crisis right now, by any means, but you can see what's happening with the Canadian economy. There's very concrete signs that the economy is slowing quite significantly, much more so even than what we're seeing in the US. And I would argue that the housing situation is much more precarious already. We've got months of inventory that are now nationally, back to kind of pre-COVID levels and trending sharply higher. And in major metros like Toronto, they're back to basically where they were in the financial crisis. And so that argues that we've got significantly more downward pressure. We've got an economy that looks extremely soft, and so um, yeah, there's trouble in it arguably coming to, in the near future, but I wouldn't characterize it as a crisis or anything like that right now. But again, 25, 26 is going to be a real problem if rates are anywhere near where they are now.
And with Canada's immigration policy, which is huge, right? I'm curious as to, you know, how is this exactly affecting the housing market? And, if are these people all renting or are they buying homes?
Yeah, that's a great question. So th- there's a lot to unpack there. I think the whole population dynamic in Canada is probably the most misunderstood dynamic that we're seeing right now in this country. And so just to frame it for the listeners. So I said earlier, population growth is 3%. So in Canada, that's about 1.2 million people added to the population the past year. I mean, just monster numbers. Now, the federal government targets about 500,000 permanent residents. And so on a net basis, like typically nets out to kind of 420,000 once you account for some Canadians that leave. So net immigration on a permanent basis adds kind of 450,000. So how do we get to 1.2 million? The answer is non-permanent residents, and that's overwhelmingly international students. And very importantly, it's temporary workers. So we added 400,000 temporary workers in the last year. And so what I would point out to people is, if you're anchoring off of this recent population surge as being anything like a new normal, there's a couple things you have to consider. The first is the politics around immigration have changed dramatically in Canada. All of the polls have shown a dramatic deterioration in support for the current level of immigration, because everybody recognizes that if you take 1.2 million people and throw it into the Canadian population, you have all these externalities like just a incredibly chaotic rental market, as you mentioned, Tracy. And so we've really seen a significant pushback among the Canadian population to these levels of immigration, to the point where you have the immigration minister just last month saying that the system is broken as it relates to temporary residents. And so the where this becomes important is, so if you're going to assume that the current level of population growth in Canada is anything close to sustainable, you have to assume that in the next year, Canada will require another net 400,000 temporary workers. But you contrast that with what's happening in terms of job vacancies, which are plunging, right, and are now back to pre-COVID lows. And so where's the demand for labor going to come from? And more to that point, in every prior recession that we've seen in Canada, the non-permanent resident cohort typically sees outflows, right? It's not just that they go flat; you see significant outflows. The most significant recession in the early '90s saw the non-permanent resident cohort cut in half. Now, in Canada today, you have 6% of the total Canadian population is non-permanent residents. I mean, it's a massive number. It looks like a hockey stick when you look at it back historically. We've never seen this, and so we don't know what that looks like in a recession. But I'm very, very comfortable making the call that population growth is going to be dramatically lower than it is right now when you roll this forward a year or two. I mean, it's not even going to be close. So anybody anchoring off of this is like a new normal is just not looking at the composition of this growth.
And with that, and then I know you have a hard stop, so I'll let you go first for the final round question. And that question is, if you can talk about something that you wanted to talk about that we didn't get a chance to discuss, and or what should we as investors kind of be paying close attention to in this market over the next 12 to 36 months.
Sure. So I think the two areas that the folks will want to watch. The first is so in Canada, we have this strange dynamic where about a third of the outstanding mortgage balance in Canada are these variable rate mortgages. Okay. But then 80% of those are static payment, which is kind of a unique to Canada construct, where as the rate goes up, we just naturally extend the amortization out to infinity, where you have some banks in Canada have 20% of their loan books that are now negatively amortizing. Okay. But what's important within that is you have two major Canadian banks that have true floating payment variable, and that would be BNS and National. And so we're going to get sort of an early look at how borrowers are going to handle those higher rates, because those borrowers have seen a dramatic increase already in payments. And so far, we haven't seen anything, alarming, but you are seeing early stage delinquency starting to move pretty materially. And so investors are going to watch that you're really going to watch that. If those two lenders skate the next year and a half without any real issues, then it's kind of hard to make the argument that the other banks are going to have problems. Okay. That's one. The second area, and this again, something that's not really well understood, but in Canada, our non-prime mortgages are overwhelmingly 1 and 2 year terms. Okay. So we put our riskiest borrowers into ultra short terms. And so I would point to a lender like Equitable Bank. So EQB, their non-prime loans are
Oh, I think you're cutting out a bit.
going from, oh, can you hear me? Sorry, I had a call come in. I apologize. So if you had a loan there, you're basically going from 3.5% 2 years ago, and it's renewing today at 7.5 or 8%. That's a monster move. I mean, there's just no way that's going to be manageable for their entire loan book. And so I would look to those two areas for potential signs of stress. And concurrent with that, I would say that if those areas are fine, if the non-prime market is fine, and the true variable payment market is fine, it's hard to get really worked up about the rest of the market. So that's where I would be focusing.
Excellent. Thank you. And then Melody, the same question to you. It's final thoughts. You can talk about something that you didn't get a chance to talk about that you wanted to address, and or what should we be really focused on in this market over the next 12 to 36 months?
Sure. And so I'll mention something that also contributes because, it is a different our two market. And that's that, we remember the arms or the adjustable rate mortgages from the last time around where, essentially non-prime borrowers, typically investors, were told that they could refi, So essentially we kind of, we have something that I don't think a lot of people are really looking at yet because it hasn't started to really show itself. And that is these rate buy downs that Tracy referenced earlier in the call that the builders were doing. Right. Here's the thing. It's not just the builders that are doing the rate buy down. It's also, there's programs backed by the GSEs. There's also, these down payment assistance programs. There was over $10 billion last year in the United States for down payment assistance. And a lot of those programs are buy down as well. And so ultimately what we set up, because they, people will quibble with me on Twitter that they're not ARPs. And I'm not saying they are, but what I'm saying is they're effectively the same because what happens is they start to reset. So these things started in earnest July of 2, and we've only just had the first reset. But some of them won't be fully reset for, about 3 years. So I think that this is going, when most people are thinking, we haven't done anything similar to the last time, reality, buy downs are going to effectively act as arms as people's payments reset. And it could be a 3-2-1 program where, it essentially it kind of steps up over the 3 years, or it could be, a rate reset 2 years. There's all different programs out there. So I think that's a risk that folks are really thinking about. And I think that what was said here in the United States was you could date the rate. And so if mortgage rates, essentially don't go down to a level that makes a refinance logical or, then this could be problematic as well. And if prices don't go down, then those folks who have those resetting rates are not going to be able to find, an affordable place to live. But, my contention is that obviously they are going to go down. They just might not go down fast enough. And then the other thing I would say is that although it's not sexy, property tax insurance are crushing your prime borrowers right now. And I think that in many ways, similar to what happened, in previous crisis with the investors, the fraudsters, the speculation, that's where it will start. And we also have to look outside of the traditional mortgage market. We have because many of these purchases were quotation mark all cash. But what we know is that a lot of places like TNC, wealth management groups pushing personal loans to people so that they can pay all cash in the housing market. And so where people say all cash sells, which were about 30%, I don't think that was 30% of really unleveraged money. So I think that the trouble might start outside of the mortgage market, and that's going to be to folks as these increased property tax insurance discourse to a lot of these investors and or fraudsters. And then I think you're starting to see the trouble in your prime borrower due to these increases, which it may take some time to play out. It may take 2 years, less we job loss.
Excellent. Thank you. I want to thank you both for your time today. I really appreciate it. I know the audience appreciates it. Follow both these guys on Twitter or X, sorry. They both put out a lot of really good information. And also, if you guys want to head over to Anthony Crudele's space that is starting right now, he's interviewing Damp Spring and Jam Croissant. So, and they're going to talk market. And with that, thank you again for your time. Thank you, everybody, for listening. And we will see you next Wednesday.
Thank you so much, Tracy. Thank you, everyone.
Thanks, Tracy.